December 27th, 2025. The world is busy preparing for the new year, but the richest man on earth just sent a shockwave through the global financial markets with a single social media post. Elon Musk, the visionary behind Tesla and SpaceX, a man who has mastered the art of vertical integration and global logistics, publicly admitted a terrifying reality. He did not tweet about space exploration or artificial intelligence. Instead, he issued a stark warning about a metal that humanity has used for 5,000 years: silver. Musk stated that silver is a critical bottleneck for many industrial processes, and more importantly, that securing a steady supply has become nearly impossible. For an investor, this is the ultimate red flag. You do not see a $200 billion CEO complain about raw materials unless the system is fundamentally broken. Think about the scale of this problem. Musk has successfully negotiated massive contracts with NASA. He has built the world's most sophisticated battery factories in the Nevada desert. He has navigated global semiconductor shortages that crippled other automakers. Yet, here he is, signaling to his 90 million followers that he has met a wall he cannot climb. The traditional procurement channels that Tesla relies on have failed. This was not a casual observation or a complaint about rising costs. It was a distress signal. When the person with virtually unlimited capital and the best supply chain experts in the world cannot quietly solve a material shortage through normal business channels, it means the physical supply is evaporating. We are not talking about a rare, exotic element discovered in a laboratory. We are talking about silver, the most conductive element on the periodic table. The reason Musk is panicking is simple math. Every single Tesla vehicle rolling off the assembly line requires between 25 and 50 grams of high-purity silver. From the complex circuit boards that power the autopilot system to the heavy-duty electrical contacts in the battery packs, silver is the lifeblood of the electric vehicle revolution. Without it, the production lines in Texas, California, Berlin, and Shanghai come to a grinding halt. But the crisis goes deeper than Tesla. Musk knows what is coming in exactly 4 days. While the general public is focused on holiday celebrations, a geopolitical shift is occurring in the East that will rewrite the rules of the global economy. The distress signal from Musk is the first domino to fall in a sequence that leads directly to a massive supply explosion. The richest man in the world has just told you that the vault is empty. In the next few minutes, we will look at why the world's primary source of silver is about to disappear, and why a price of $100 per ounce might be the floor, not the ceiling. While the West remains distracted by Elon Musk's social media warnings, the government in Beijing has quietly finalized a strategy that has been decades in the making. On January 1st, 2026, a new regulatory framework for silver exports officially goes into effect. This is not a temporary measure or a minor administrative change. It is a calculated strike at the heart of Western industrial stability. Most investors think of China as just another player in the silver market, but the reality is that they are the undisputed gatekeeper. China does not just mine silver. They have systematically built a monopoly on the refining infrastructure required to turn raw ore into the 99.9% pure silver needed for high-tech manufacturing. According to the United States Geological Survey, China processes more silver than the next 3 nations combined. They have spent 20 years encouraging Western nations to outsource their refining capacity in pursuit of lower costs. We fell for the trap. We traded our strategic security for a 30% discount on refining fees, and now China is changing the locks on the global supply chain. The new mandate is brilliantly disguised as a quality control measure. It requires any company wishing to export refined silver to prove an annual production capacity of at least 80 metric tons and maintain a credit line exceeding $30 million. On the surface, it sounds like standardizing the industry. But here is the devastating truth. The vast majority of silver refiners in China are small to medium-sized operations that produce between 20 and 40 metric tons per year. These smaller facilities are the ones that provide the overflow capacity and flexibility the global market relies on during times of high demand. By setting the bar at 80 metric tons, China is effectively banning 60 to 70% of its refining capacity from the international market. This metal will not disappear, but it will be legally restricted to domestic use only. This ensures that Chinese companies like BYD and their massive solar panel manufacturers have first priority and lower prices, while Western companies like Tesla and Ford are forced to compete for the scraps exported by a handful of large, state-connected firms. The $30 million credit requirement acts as a second filter, bankrupting or sidelining private refiners that do not have direct backing from the central government. This is financial engineering used as a weapon of war. China has realized that in the 21st century, controlling the flow of critical conductive metals is more powerful than controlling the flow of oil. They are choosing to keep their silver at home to power their own green energy transition, leaving the rest of the world to deal with a sudden and permanent supply shock. The market is already reacting. In Shanghai, silver is already trading at a premium of $5 per ounce compared to London and New York. This gap, known as the Shanghai Premium, is the sound of the exit doors closing. It tells us that the physical metal is already being hoarded inside Chinese borders. When the clock strikes midnight on January 1st, the licensing system becomes a digital wall. For Western procurement officers, the nightmare is no longer about the price of silver. It is about whether the silver exists for them at all. In the world of investing, we often assume that when the price of a commodity gets too high, the market will simply find a cheaper substitute. If beef becomes too expensive, people buy chicken. If oil prices spike, we look toward natural gas. But when it comes to the high-tech industrial applications of silver, the laws of economics must eventually bow to the laws of physics. Engineers at companies like Tesla, Apple, and Samsung have spent decades and billions of dollars trying to find a replacement for silver. Their conclusion is always the same: there is no plan B. Silver is the most electrically conductive element in existence. On a scale of 0 to 100, silver is the gold standard at 100. Copper, its closest affordable rival, sits at roughly 97. While a 3% difference might sound negligible, in the world of microelectronics and high-efficiency energy, 3% is the difference between a product that works and one that fails. When you are designing a printed circuit board for a smartphone or an autonomous driving computer, you are dealing with extremely tight spaces and high thermal loads. Silver allows electricity to flow with the least amount of resistance, which means less heat is generated. In the photovoltaic industry, which produces solar panels, silver is used as a conductive paste to collect the electrons generated by sunlight. Over the last 10 years, manufacturers have managed to reduce the amount of silver used per cell by 60% through a process called thrifting. They use thinner lines and better formulations to save costs. However, we have now hit a physical floor. If you reduce the silver content any further, the electrical resistance increases so much that the solar panel loses its efficiency and becomes commercially useless. The World Silver Institute reports that solar demand alone now consumes over 500 million ounces of silver annually. This is non-negotiable demand. The same story applies to the electric vehicle sector. A modern electric car is essentially a high-powered computer on wheels. It requires thousands of silver-coated contacts to ensure that signals are transmitted instantly and reliably between the battery, the motors, and the sensors. Copper can be used for heavy power cables, but for the delicate connections in the brain of the car, physics demands silver. You cannot cheat nature. If Elon Musk wants to build a car that is both safe and efficient, he must have silver. Gold is a better conductor in terms of preventing corrosion, but at over $2,000 per ounce, it is economically impossible to use at the scale required for mass production. This leaves silver in a unique position. It is precious enough to be rare, but industrial enough to be essential. As we move further into the age of the green energy transition and the fourth industrial revolution, our reliance on this metal only grows. We are building a future that is physically dependent on a substance that is becoming harder to find every single day. When the supply from China gets cut off, you cannot simply flip a switch and use something else. You either have the silver or you shut down the factory. The most dangerous assumption a casual investor can make is that a higher price will automatically lead to more supply. In most industries, if the price of a product doubles, companies will work overtime to produce more. But the silver market is trapped by a geological reality that defies conventional economic logic. This is what experts call the byproduct paradox. According to data from the Silver Institute, roughly 80% of all silver produced globally is not found in silver mines. Instead, it is a secondary byproduct of mining for other metals like copper, zinc, lead, and gold. Think about what this means for the global supply chain. Imagine a massive copper mine in Chile or a zinc mine in Australia. The primary reason those companies spend billions of dollars on infrastructure is to extract copper or zinc. Silver is just a bonus that happens to be in the same rock. If the price of silver skyrockets to $100 per ounce, the manager of a copper mine cannot simply decide to produce more silver. To get more silver, they would have to mine more copper. But if the global demand for copper is weak, or if copper prices are stagnant, expanding the mine would be a financial disaster. The production ratio is fixed by nature, not by the stock market. It is like trying to get more egg whites without producing more egg yolks. You are at the mercy of the geology. This means that silver supply is incredibly inelastic. Even if Elon Musk offered to double the price for any miner who could increase production, most miners would have to tell him no. They are already running their machines at full capacity to meet their copper and zinc quotas. Only about 20% of global production comes from primary silver mines, where silver is the main economic driver. These mines, located mostly in Mexico and Peru, are already aging. The average grade of silver ore, which is the amount of silver found in each ton of rock, has been declining for over a decade. Miners have to dig deeper and process more earth just to maintain the same level of output. This creates a perfect storm. On one side, you have exponential growth in demand from electric vehicles, solar energy, and artificial intelligence. On the other side, you have a supply that is physically constrained by the production of other metals and declining ore grades. Historically, when a commodity faces this kind of structural imbalance, the only way for the market to adjust is through a massive, violent repricing. The price must rise high enough to force people to stop using the metal. But as we established, the industrial world cannot stop using silver. We are heading toward a collision between an unstoppable force of demand and an immovable object of geological supply. When the Chinese export ban hits this fragile system, there will be no safety net. To understand why the current situation is so critical, we have to look past the daily price fluctuations and focus on the cold, hard data of global inventory. For the last 5 consecutive years, the world has lived in a state of structural silver deficit. This is not a theory or a speculative forecast. It is a documented reality. Human civilization has consumed more silver than we have pulled from the ground every single year since 2021. We have been filling that gap by draining the massive stockpiles that took decades to accumulate. Now, those vaults are starting to echo. According to the Silver Institute, the cumulative deficit from 2021 through 2025 has exceeded 800 million ounces. In 2025 alone, global fabrication demand hit 1,240,000,000 ounces, while mine supply and recycling combined delivered only 1,010,000,000 ounces. That is a 230 million ounce shortfall in just 12 months. To put that in perspective, imagine every single person in the state of Texas needing to find 7 ounces of silver from their own pockets just to cover 1 year's deficit. Where has this extra metal come from? It has come from the 2 most important warehouses in the world, the COMEX in New York and the London Bullion Market Association, or LBMA. The collapse of these inventories is the smoking gun of a looming crisis. In 2020, registered silver inventories on the COMEX, which is the metal available for immediate delivery, stood at 346 million ounces. Today, that number has crashed to 82 million ounces. That is a 70% collapse. The situation in London is equally precarious. While the LBMA reports total vaulted silver at 827 million ounces, we must look closer at the ownership. Over 550 million ounces of that total are owned by exchange-traded funds, or ETFs. These are investment vehicles where the metal is legally tied to shareholders who expect physical backing. You cannot simply raid an ETF vault to supply a Tesla factory without triggering massive legal nightmares and a total loss of investor confidence. When you remove the metal that is already committed to long-term holders in ETFs, the actual float metal, the silver available for new buyers, shrinks to a terrifying 30 or 40 million ounces. That represents only about 30 days of global industrial consumption. We are running a global high-tech economy on a 30-day supply cushion. The world has been living on borrowed time and borrowed metal. We have used these stockpiles to paper over the fact that our demand has outpaced our production capacity. But you can only drain a vault once. With China now closing its doors to exports, the Western world can no longer rely on the East to replenish these inventories. We are about to find out what happens when a global manufacturing machine running at full speed hits an empty warehouse. The bill is coming due, and the price will be paid in a massive upward revaluation of every available ounce of silver. In the modern financial world, most people who think they own silver actually only own a piece of paper. The global silver market is built on a massive pyramid of leverage where paper contracts, known as futures, trade at volumes that dwarf the actual physical metal in existence. On a typical trading day, the volume of silver traded on paper exchanges like the COMEX can represent more silver than the entire world mines in a year. This system works perfectly as long as everyone is happy with cash settlements. But the moment buyers lose faith in the paper and demand the physical metal, the pyramid begins to crumble. We have seen this movie before, and it always ends in a disaster for the shorts. Look at the nickel crisis on the London Metal Exchange in March 2022. A large Chinese producer held a massive short position, betting that nickel prices would fall. Instead, supply fears caused prices to spike. When the producer couldn't deliver the physical metal or meet the margin calls, the price of nickel doubled from $50,000 to over $100,000 per metric ton in a matter of hours. The exchange was forced to take the unprecedented step of suspending trading and canceling billions of dollars in trades to prevent a total systemic collapse. Silver is now facing a similar setup, but on a much larger scale. The open interest on silver futures, which represents the total number of outstanding contracts, regularly exceeds 500 million ounces. Compare that to the 82 million ounces of registered inventory we discussed in the previous section. That is a leverage ratio of 6-to-1. If even 20% of those contract holders decided they wanted physical delivery instead of a cash check, the exchange would be empty in a single afternoon. This is the nightmare scenario for the paper markets. When a company like Tesla or a solar manufacturer realizes they cannot get silver from their usual suppliers in China, they will turn to the futures market to secure their needs. They will not be looking for a speculative profit. They will be looking for bars of metal to keep their factories running. When industrial giants start demanding physical delivery, they force the paper shorts to scramble for a diminishing supply of metal. This creates what traders call a short squeeze. As the price rises, the people who sold paper silver are forced to buy it back at any price to close their positions, which only pushes the price higher. We are already seeing the first signs of this disconnect. While the paper price on the screen might say $80, the actual price to get physical delivery in large quantities is already significantly higher. In a true crisis, the paper price becomes irrelevant. If the exchange cannot deliver the metal, the contract is just an empty promise. The world is about to rediscover a hard lesson. You cannot build a solar panel or a car out of a paper contract. When the music stops, only those holding the physical metal will be left standing. In the world of professional commodity trading, there is a signal that experienced investors watch more closely than anything else. It is not the news headlines or the central bank announcements. It is the price difference between the East and the West. For most of the last decade, silver prices in London, New York, and Shanghai were nearly identical. But as we head into the final days of 2025, that harmony has been shattered. We are now witnessing a massive expansion of what is known as the Shanghai Premium, and it is the ultimate early warning system for a global physical shortage. As of late December, while the paper silver price on the COMEX in New York is hovering around $71 to $72, the physical price on the Shanghai Gold Exchange has surged past $79 per ounce. That is a premium of over 10%. In the world of precious metals, a 10% gap between two major exchanges is not just a data glitch, it is an economic earthquake. It means that the market is fragmenting. It means that the physical metal in China is staying in China because domestic buyers are willing to pay a massive surplus to ensure they have the material they need. Why does the Shanghai price matter more than New York? Because the Shanghai Gold Exchange is primarily a physical market. Unlike the COMEX, where less than 1% of contracts result in the delivery of actual metal, the Shanghai Exchange is designed for the movement of physical bars. When the price in Shanghai is significantly higher than the price in the West, it creates an irresistible vacuum. Under normal circumstances, arbitrage traders would buy cheap silver in London and ship it to Shanghai to pocket the profit. But this arbitrage is no longer working. The reason the gap is not closing is that there is no surplus physical silver left in Western vaults to ship. We saw this in October 2025 when China exported a record-breaking 660 metric tons of silver in a single month. That was a desperate move to ease the extreme supply squeeze in Western markets, but it has left Chinese domestic warehouses at their lowest levels since 2015. According to the Shanghai Futures Exchange, inventories have plummeted by over 40% from their 2024 peaks. The Shanghai Premium is telling us two things. First, it confirms that the physical shortage is real and it is happening right now. Second, it shows that Chinese industrial buyers who produce the majority of the world's solar panels and electronics are already hoarding every ounce they can find before the export restrictions of January 1st. They know that once the new licensing system is active, the flow of metal will be strictly controlled by the state. This premium is the market's way of screaming that the paper price in the West is a lie. The real price of silver is the price you have to pay to actually hold it in your hand, and in Shanghai, that price is already knocking on the door of $80. When the Western markets reopen after the new year, they will be forced to gap up to meet this Eastern reality, or they will watch as their remaining inventories disappear overnight. As we approach the January 1st deadline, the global silver market is transforming from a traditional commodity exchange into a theater of industrial warfare. We are no longer talking about traders betting on price movements. We are talking about a desperate bidding war between the most powerful corporations on the planet. When Elon Musk tweets that silver shortages are not good, he is not just observing the market. He is signaling that Tesla is now in a direct, zero-sum competition with every other major manufacturer for a shrinking pool of physical metal. Think about the scale of the opponents in this arena. On one side, you have the automotive giants like Tesla, Ford, and BYD, who need silver for the electrification of their entire fleets. On the other side, you have the titans of green energy, the solar panel manufacturers who consume over 500 million ounces a year. And joining the fray are the semiconductor and artificial intelligence leaders like Samsung and Apple, who require high-purity silver for the next generation of AI servers and foldable devices. In this environment, price sensitivity completely evaporates. For a company like Apple or Samsung, the cost of silver in a single smartphone is measured in cents. Even if the price of silver triples, it has almost zero impact on their final profit margin. However, the cost of not having silver is catastrophic. If Samsung cannot secure enough silver paste for its memory chips, a multi-billion-dollar production line sits idle. In the world of high-tech manufacturing, an idle factory is a financial death sentence. Therefore, these companies will pay whatever it takes. They will bid $80, $100, or even $200 an ounce just to ensure their assembly lines keep moving. This creates a brutal reality for smaller players. If you are a mid-sized electronics firm or a local solar installer, you are now competing for supply against the deepest pockets in human history. When supply is restricted, suppliers prioritize their largest, most reliable contracts. They will fulfill the orders for Tesla and Apple first, leaving the rest of the world to fight over the scraps. We are already seeing evidence of this as small manufacturers report that their orders are being canceled or delayed indefinitely. The strategy has shifted from just-in-time procurement to just-in-case hoarding. Large corporations are no longer buying what they need for the next month. They are trying to lock up supply for the next 2 years. They are bypassed the paper exchanges entirely and going directly to the miners with massive upfront cash offers. This bypass further drains the liquidity of the public markets, making the official price even more volatile. The industrial warfare for silver is just beginning, and in this fight, the only way to survive is to have more capital and more political influence than your neighbor. For the average investor, this corporate desperation is the ultimate confirmation that the silver era has arrived. As we stand on the precipice of January 1st, 2026, the question is no longer if silver will rise, but how high the explosion will go. For decades, the $100 mark was dismissed as a fantasy of gold bugs and fringe theorists. But today it has become a conservative target for many of the world's leading commodity analysts. As of late December, silver has already breached the $80 level, a staggering gain of over 150% in a single year. We are no longer in a normal market. We have entered a phase of price discovery where historical precedents no longer apply. The logic behind $100 silver is rooted in a simple, brutal calculation. When a market remains in a structural deficit for 5 consecutive years and the primary source of refined supply is suddenly restricted by geopolitical decree, the price must rise to a level where demand is forcibly destroyed. However, as we have seen, industrial demand from giants like Tesla and Samsung is price inelastic. They will continue to buy until they are the only ones left. This means the price must climb high enough to price out every other participant, jewelry buyers, silverware manufacturers, and retail investors, leaving only the essential high-tech industries. Technical analysts are pointing to a massive breakout pattern that has been forming for over 40 years. Silver spent decades trapped below $50, creating a base of support that is incredibly strong. Now that this ceiling has been shattered, there is very little technical resistance left. Some experts, including those from major institutions like BNP Paribas and independent analysts like Michael Oliver, suggest that once the momentum truly takes hold, we could see spikes toward $150 or even $200 per ounce during periods of acute physical shortage. We must also consider the gold to silver ratio. Historically, this ratio has hovered around 15-1, reflecting the natural occurrence of the two metals in the Earth's crust. For much of the last few years, the ratio was stretched to an absurd 80-1. As silver begins its catch-up phase, we are seeing this ratio collapse. If gold continues its climb toward $5,000 and the gold-to-silver ratio returns to its historical average of 15 or even 30-1, the math points directly to triple-digit silver. The final catalyst will be the re-entry of the institutional investor. For years, big banks and hedge funds ignored silver because the market was too small and too volatile. But as silver becomes a strategic asset, classified by governments as a critical mineral, large pools of capital are beginning to rotate into the sector. This is the wall of money that creates a blow-off top. When the world realizes that silver is not just a shiny metal, but the indispensable fuel of the digital and green revolution, the scramble to own it will be unlike anything we have seen since the 1970s. $100 is not the end of the journey. It is simply the moment the world finally wakes up to the true value of the white metal. We are now in the final hours of the old silver market. In less than 72 hours, when the clock strikes midnight on January 1st, 2026, the global silver trade will be split in two. On one side, a protected Chinese market with deep reserves and prioritized domestic supply. On the other, a Western market facing its most severe physical shortage in modern history. Elon Musk's warning was the final signal for those paying attention. The era of cheap, abundant, and easily accessible industrial silver is over. For the individual investor, this is the moment of truth. History shows that in a supply squeeze, the biggest gains are not made during the peak of the crisis, but in the quiet moments just before the public realizes what is happening. By the time the mainstream media is reporting on factory shutdowns and silver hitting triple digits, the best entry points will be long gone. Your strategy in this environment should be built on 3 pillars. First, prioritize physical possession over paper promises. If the lesson from the nickel crisis taught us anything, it is that exchanges can and will freeze trading to protect the shorts. A silver futures contract or a digital certificate is only as good as the exchange's ability to deliver. In a true shortage, the only silver you truly own is the silver you can touch. Second, watch the Shanghai Premium as your daily compass. If the gap between the Eastern and Western prices continues to widen, it is a sign that the physical drain is accelerating. This is the lead indicator that will tell you when the Western exchanges are about to face a delivery failure. Finally, recognize that we are not just witnessing a price spike, we are witnessing a fundamental re-rating of a strategic asset. Silver is moving from the category of a speculative commodity to a critical national security mineral. Governments will soon begin building their own strategic silver reserves, just as they do with oil and gold. When sovereign states enter a market that is already in a deficit, the price floor shifts permanently higher. The window of opportunity is closing. You have a choice to act while the market is still functioning or wait and try to buy in a market defined by rationing and massive premiums. The math is clear, the physics are absolute, and the geopolitical timer is ticking. Elon Musk has made his move. China has made its move. Now the only question that remains is, what will you do before the new year begins? The silver is waiting, but it will not wait forever.